All right, guys. Thank you for joining us back from that quick break. This next session, super excited. We always love speaking to David here. David is from TradeStation Group, and he is going to take us on a deep dive into what kind of market we are in. Thank you so much for being here with us, David.
Hey, Haley, it's great to be with you.
Awesome. Well, I'm going to turn it over to you and let you take it away here, but thanks so much.
Okay, great. Now I think good. It looks like you already shared the zip file, which is great. I'm going to start my
Yes.
screen share and let me
Yep.
know if anything is if it comes through okay. I'm going to share.
Yep. And for anyone who sees that zip file now or needs it, we will share that again throughout. So no worries if you didn't grab it right away.
Great. All right. Well, thank you, Haley. So, all right, folks, it's great to be with everyone. I am the VP of Market Intelligence here at TradeStation Group. And one of the things I do is I do the Market Insights blog. And I use the platform a lot to always be kind of assessing the market and doing analysis, looking for opportunities. And I'm going to share some of my techniques with you. That's one of the things I'm really going to be looking to do today. First, let me just read some disclosures. The following presentation is for educational purposes only. All symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. Strategy trading and active trading is not suitable for everyone. Futures trading, options trading, and active trading is not suitable for everyone. Past historical performance does not guarantee future results and may not be indicative of future performance. All educational content and custom easy language studies provided are examples for educational purposes only. Neither TradeStation Group or any of its affiliates suggest or recommend trading indicator scan strategies or any other investment or trading advice of any kind. You alone assume any trading risk associated with the analysis or trading examples provided. Okay, great. So wanted to just quickly kind of run through and show a few things. The first one to mention is when you go to the zip file that we've shared, this is what you will see. You'll see four things in it. This one is actually the PowerPoint. These are the slides. Then there's two TradeStation workspaces I'm going to be using. And then the other thing is this ELD file. Now, what you want to do is you want to load the ELD file first on your TradeStation platform. That will bring in a series of indicators that are then used by the workspaces. And then I actually have the workspaces loaded right here. Actually, I have one of them. I need to load this one next. But make sure it's important that you load the ELD first. There's the other one. Okay. So, as we look here, I'm going to kind of talk about, to me, what I think is the important thing about understanding, the leadership in the stock market at different times. Because the thing is that the market really does go through different kinds of moods, and there's different kinds of behavior at different points in time that can be understood. These can have reasons why they're happening, and in many ways, from my perspective, when we're looking at things as investors and as traders, we don't always care so much as the why. We really care about the what. Certain areas are doing well, certain areas are not doing well. We want to understand that and then identify trends. That's the first thing we're really trying to do. And then secondarily, we want to position accordingly. So it's always a question of first diagnosing and then acting. All right. So as we look at the market overall, I believe that you can kind of this is probably not a complete list. You can maybe adjust it a few ways, but the market essentially goes through periods like we see here on this presentation, which is based on this slide. We can go through periods of just risk off when fear is increasing. There's times of complacency. There's times when people are focused on certain sectors over others. There's times when people are focused on something like cyclical growth, which is things like the economy is roaring back to life, energy prices are going higher, interest rates are going higher, or the opposite. And that's the sort of thing that will determine how the market behaves, and we want to position according to that. There's times when we're in domestic versus global. There's times when the global sectors are doing far better, the global stocks. There's times when people are interested in interest rates, like right now. Right now is one of those times when interest rates are a major consideration. One of the things that we haven't seen recently, but it can come back, is this idea of M&A and strategic events. And that's when there's times when you just have a whole bunch of mergers and acquisitions in an area. You have companies that are doing things like spinning off different divisions and things like that. They used to be a lot more common. It's less common now, but it can come back. And then there's other times which you might not have heard of, but you have big cap versus equal cap weighting, which is an interesting way to look at the market. And I'm going to show you tools to do that because it's pretty good. So as we look at this cyclical outperformance, this is when you really see energy, financials, and industrials outperforming. It almost always corresponds to rising interest rates. This is not very favorable for technology and growth stocks. So right now, let me just actually, before I move on, let me go over to the blog that I published for TradeStation. If you go to the TradeStation website, tradestation.com, and you go to Insights, my blog has a lot of articles about these different things right now that are happening. I had written a lot about what's been happening with technology stocks. And if you actually go down, this article was just, in the last few days, I did this article showing about this shift toward growth stocks. It was this article about, is it time to sell Apple? So the thing is, and I'm going to explain this, I'm going to show you how to find it. When you have interest rates moving higher, that is usually bad for technology stocks. And the reason is because technology stocks have low earnings multiples. And when interest rates are going up, people don't want companies with low earnings multiples. And the reason is because if you flip earnings on their head, on a PE ratio on its head, you actually get price over earnings. If you turn it around, you get earnings over price. And that is what's called the earnings yield. And when the earnings yield is low, it means the valuation is high. And when interest rates move up, it's bad for stocks with high earnings, with low earnings yields. And it's just it's a very mathematical sort of analysis, but it's very much the case. And a lot of strategists, when they look at interest rate environments, they will actually say when interest rates are going higher, that's bad for your high multiple stocks. And they use this analysis. It fits in with things like discounted cash flow. A lot of valuation multiples are based on this. Right now, we're in one of those environments. I know a lot of people like tech stocks and things, but right now we're in an environment that, kind of like when the vaccine news came out, 11 months ago now, it's hard to believe, we had a period for about 4 months when financials and energy did great and technology stocks lagged. That more or less lasted through June, and with a few waves here and there. And we could be in a situation now where things are swinging back in that direction. Another thing that can happen is, and this is equal weighted outperformance. And what's interesting about this is that there's times when people want to buy big stocks, and there's times they buy the smaller companies, and it can be difficult to actually, assess that. But I'm going to show you some tools on how to understand that. Okay, so when you have very often a lower VIX, you go through a period of volatility fading, then people are going to start going to these smaller sort of companies like small caps. And then some of these are ETFs. The IWM is the General Russell 2000, but then you also have the small cap growth ETF, and you have this QQQJ, which is the smaller members of the NASDAQ, which are not in the NASDAQ 100. When you're in a period like we were, last year around like June of 2020, it was a period when all these tech stocks were going up a lot. They were like doubling and tripling. This is a period of time when you had companies like Fastly that had high earnings, very high multiples, very high growth rates. They had these big rallies. That was a period of time when these smaller growth stocks did well. But just because companies are small, sometimes that can favor industrial stocks too. So it can be useful to look at things based on their overall size. Like I said, it can apply to cyclical or secular growth. The next thing is just a period of time when we have the opposite of that, which is big cap outperformance. There's a period of time starting around 2017 when the FANG stocks just absolutely outperformed everything. And that period, I mean, there's reason to think that this could be the end of it for various things that we're seeing, especially trouble with Facebook, and some of the other things of these companies simply reaching that size, and interest rates moving higher. But there are times when you're going to actually see periods when a few big names lead, and then everything else kind of lags. There's times here when you're going to see the dollar weakening, and you're going to see global stocks outperforming. That has not been the case lately, and it doesn't look like it's going to be the case soon, especially the Federal Reserve, moving back toward higher interest rate policy, tapering their asset purchases, and possibly hiking interest rates next year. Generally, the thing about a global, environment is it's going to be when people are risk on, looking for more sort of stocks that are more risky and less risk, less safe haven kind of stuff. There's other times, and it's interesting to recognize this. The market will often go through cycles when we're essentially, say, the market's going higher and everything is complacent. People feel good about things. During times like that, you're going to see the S&P move very small amounts, maybe like 0.2% in a day. The volatility index goes down. And then you get to a point of complacency. And people say the market should pull back, what's happening? And then suddenly it starts crashing. In some ways, it's kind of like we saw in September. There was a period of complacency. We knew the Fed was going to start wanting to taper. We knew there were issues out there, and the market was just sitting at kind of highs. And we had written about that at the time, about how it was essentially sitting at a high at the same time that there was potential for risk going into September, October, many ways because of the Fed. And then you get into a period of the market starts crashing. When that happens, you see your volatility move up. And then you get into a period of time when you want to focus on trading indexes and moving away from stock picking. So the thing is, when you're in a market, when everything is crashing together, what will happen is volatility moves up, but not only volatility, correlation moves up, which means that why bother trading individual stocks when you can just trade SPY or S&P futures? And that's when it makes sense to trade the indexes. When volatility goes down a lot, the indexes don't move as much. But when you're in a volatility environment, you're going to have a more of a favorable environment for trading the indexes. So sometimes it makes sense to just say, I don't care about Apple, I just care about trading SPY or Qs. And then other times, yes, I do care about your smaller growth stocks or whatever. But it's important to recognize that when the VIX goes up, correlation goes up. And usually what happens is the market goes into a period of complacency, then it crashes and fear increases. And on the way down, the indexes are everything. You want to just focus on the indexes. And at the beginning of the rebound, the indexes remain the main thing. But then as you start recovering, volatility comes down, the indexes start moving a lot less, and then you want to pivot back to stock picking. So it's important just to think, am I in an index market or am I in a correlated VIX dominated market? And that's what I said here, the uncorrelated low volatility market. The VIX subsides and it favors stock picking, and it usually follows some kind of sharp rebound. Okay, you can go through a period of secular growth. This favors high multiple stocks. Usually it's an environment with lower interest rates, falling interest rates, and a weaker economy, like a lot of 2020. And then it's going to favor your companies that have higher multiples and your companies that have their own organic growth story. Companies like Zoom or Salesforce.com. These software companies are growing because they didn't exist maybe 10 years ago, and now they're penetrating into new markets. That's organic growth. Those kind of companies are also secular growth. Companies like that are not as much sensitive to the economy. So they can provide growth in a weak economy. But the problem is that when the economy gets strong and it comes roaring back, people don't want stocks like that because they have high multiples and they don't offer exposure to the recovery. So you just need to look and say, are we in this kind of secular low interest rate environment or are we in a roaring recovery? That's the cyclical thing. So it's just a question of recognizing what kind of mood we're in. Then you can have things like M&A, strategic events, and that clusters around industries. There's times when all the biotech stocks start having acquisitions and other things. We haven't seen it for a while. It involves things like takeovers and spinoffs and events like that. Okay, so those are some of the basic things that you could maybe quibble about one or two and change them and suggest. But in my perspective, those categories of behavior in the market can apply to pretty much any environment that we're essentially in. And right now, I would say that we're in an environment that is much more like the cyclical recovery, the rising interest rate environment. And that's something that we're going to want to look at and see. All right, so we have a few methods that I'm going to go through and kind of identify. Essentially, 4 methods. The first one is really the kind of the main one. And what we want to do is we want to use key ETFs using radar screen, which is going to allow us to assess the mood of the market. So I'm going to go over now to my TradeStation platform. And this is the main workspace that we're working with. This is what it looks like for you now. When you load it, you should see this. Okay, so what is this here? This has 4 trading tools, or four trade station tools. It has radar screen. It has 3 different charts. Now, these are some pretty interesting charts. I want to just mention that you'll notice that there's the green symbol linking for all of them. That means if I click on one of these symbols, all 3 charts are going to match. If I go over here and I type in Apple or something, all 3 are going to link up. So that's just useful. You want to look at things. Right now, we're starting off by looking at the sectors. And let me just go over here and just very quickly see. Sorry. All right. So we're starting off, and I'm going to inflate this now just so you see there's 4 things, and I'm going to maximize it. All right. So I have these things broken up into kind of categories. You'll notice the labeling, things like risk on cyclical, risk on growth, and then there's just a list at the end you can look down. For me, these ETFs are a really useful way to judge the market. You don't necessarily want to trade them. Some of them don't trade very well. They're not very liquid. One of the things that is important to realize is that sometimes when you use TradeStation, if you might have like SPX, the index, or you might have futures, the tricky thing is sometimes you might have a login and you don't have a data privilege, or one customer does and one customer doesn't, whatever. So I'm using ETFs for this. That's the reason I'm doing it, is because the data is compatible. Sometimes you might have 10-minute delayed data on one and not the other, and then all the charts won't work. So I'm using the ETFs because they're always going to be the same. If you have 10-minute delayed data, it's going to be the same for all the things, and it's going to work more easily. So what this allows us to do is this allows us to look over multiple different time frames. Now I have this set up so 5D is 1 week, 5 days. It's just a really short way of I like really short things that can fit in my columns or in an organic way, or in a really simple way. Now, as I click on this, I can see in the last month, energy and financials are in the green. Now, I set this up so that the SPY is always going to be this kind of amber color. So no matter where I am, I can always benchmark back to the S&P and see, wow, what's outperforming the S&P 500? I look at this list, I can easily see the S&P in the last month is down 2%, but energy's up 18%. Financials are up 3%. Well, if you look back over on our slides, that is a cyclical boom sort of environment. So right off the bat, we know we're in a cyclical market right now. And it's not a surprise because I'm going to actually talk a little bit about the economy when I go through the presentation, because there's some really interesting things happening with the economy. That was the jobs report on Friday was one of the weirdest jobs reports I've ever seen. I think the number itself actually understates the strength of the economy. I think it was a far stronger report. We see what's happening with interest rates. I think the market saw that. So anyway, using this just right off the bat, clicking on these different columns, for example, 5D, 21D, this allows us just to see in the short term where the strength is. You have your year to date, but then there are some other columns as well. Now, this is a special tool I created called in range multiple days. It will allow us to look at a time frame, and it will tell us in this case, it's set to 21 days, which is this column tells us. It will tell us in the range, in the last 21 trading sessions, you take that entire high to low, and then you basically say, where are we in that range? And that will tell you overall where things, are they pushing the highs? Are they trending up, or are they trending down? It's not always the most useful thing, but it very often is a way to take a step back and just say, where's the strength? And you can look right here as well. The energy is at the very top of its range in the last month. And then look down here at some of these technology things. The NASDAQ is below the midpoint of its 21 session range. Semiconductors near below the midpoint, because 0 is basically the midpoint. This goes from minus 100% to positive 100%. So right off the bat, looking at this, you can see where the, where things are positioned in their ranges. Of course, you can click on these columns and you can look right down here. It's going to tell you a very simple sort of assessment. Now, over here at the very end, I have this, there's a list of pretty much all the ETFs. So it allows you to compare something like energy to, software and technology. It's really simple way to get a big view of all the major sectors. These ETFs essentially encompass, I'd say 99% of stocks in the market. And there's also the bottom here, I have some countries listed, which I think is interesting. Right now, by the way, I think there's some interesting things happening with Russia. We wrote about it recently. The Russian ETF has been breaking out. This situation happening in Europe with their natural gas is very interesting. And that's something we've covered actually, and it has been playing out. Now, the other thing I did want to mention here is on this list, we have our common indexes. The other thing here is that we talked about this equal weight versus market cap weight. Now, the RSP is not an ETF you've probably heard of. The RSP takes all 500 companies in the S&P and it gives them an equal weighting. Like in the S&P, I mean, Apple is like probably 4% or something of the whole index. If you put together Apple, Microsoft, Alphabet, Amazon, and Facebook, a few others, you've got probably 10 companies account for over 15% of the S&P's market cap. So the problem with that is that when Apple has a bad day, it overstates what's happening. So a lot of those are technology companies. Like I said, this environment, rising interest rates, bad for technology. It's going to basically drag down the overall S&P 500 because the S&P 500 overweights the bigger companies, which makes sense. But there's this other thing called the equal weighted, which will give an equal weighting to the biggest and the smallest company in the index. And what's interesting is RSP has in the last, let's look at it on a 21-day basis, it is down 1% and the S&P is down 2%. In our range, it is at the 25% mark, while the S&P is at the -8% mark. This tells us right off the bat that equal weight is outperforming. We're seeing the smaller companies stepping up, and there's money shifting from the mega caps to the smaller companies. This is an important thing to notice because it basically says, things like Apple are not where the sentiment is going now. The sentiment is moving to the smaller companies. So right off the bat, looking at this, we see right now the market we're in is a market that is cyclical, and it's a market skewing towards smaller companies and equal weighted companies. All right, now I'm going to minimize, I'm going to shrink this back down to, now you can see all four. And now I want to go over here and show you some of these other, let me just, all right, I'm going to slide 11. The thing I want to mention now is that essentially, all right, you know what, there's this other indicator. I'm going to show you this here, and then I'm going to show you on the chart. This indicator, MA cross bars since SMA EMA. I know it's not a great name, but it is descriptive. What this does is this tells you how long ago since a certain pair of moving averages crossed. In this case, it is taking in the 10-day and the 50-day simple moving average. So this is the indicator in this column. You'll notice it is 10S versus 50S. Okay, and that basically says 10-day simple, 50-day simple. If I right click on it and I go to studies, I can edit this and I can change it to anything else I want, and I can change it to exponential. So you can put in simple and you can put in exponential. It's pretty cool because you can say, I want to see when a certain moving average, a simple moving average crosses an exponential moving average. It actually can handle stuff of that level. It's a really cool indicator in my view. And it's one I created, and I'm always happy to share it with clients. But what this does is when the idea is that if you guys don't know this, a moving average crosses. The idea is when a fast moving average is above a slow moving average, then that says that it's trending higher, and vice versa to the downside. So let's actually look. First, let me show you on the chart, and then I'll show you how you can use this in radar screen. For the ETFs and the sectors, I have found that the 10-day simple against the 50-day simple is a pretty good indication of trend. So let's look at this chart down here. This is the 10-day is in yellow and the 50-day is in red. The white crosses tell us when it made a new 52-week high. So this right off the bat is going to tell us, okay, it's making new highs up here, and it hasn't made a new 52-week high in a while. Now let's click on XLE. Isn't that interesting? It made a new 52-week high on Friday. Also, notice in XLE that before it started rallying, the yellow line crossed above the red line. Now look at XL. Let's go back to the Qs. Just the opposite happened. And you'll notice back here before the Qs started rallying, the 10 crossed through the 50. Now, nothing's always going to be true, but I find this for sectors to be a pretty, it can give you a pretty good gauge of where the strength is in the sectors. If you can just look and notice that the 10-day cross above the 50, that is often going to be a sign of strength. And when the cross down occurs, you want to just kind of say, maybe it's not the best time to be playing in this space. And in my view, what we see here with this happening in the NASDAQ kind of tells me that, this is probably a time here when the NASDAQ is, probably not going to be your source of outperformance in the market. So what's cool about this indicator over here, so let's look at the 10 and the 50, okay? Now, if we inflate this, look at this. This is a way to actually assess that across the whole market. This will tell us if the 10-day is above the 50-day, it's going to give us a positive number and a negative number if it's below. But it's also going to tell us how long ago the cross happened, which is useful because this allows us to see. We look down here at something like, energy. It's interesting to look. The energy crossed above 11 days ago, and the XOP, which is a higher beta energy ETF, crossed 19 days ago. So the XOP gave a very clear signal. Here's XOP. It gave that signal right here on the 13th of September. So by the way, I would like to mention that if you go over to Market Insights or our blog and you look back and we go to sectors energy, I wrote an article here with the oil tanker, with this tanker stock. I might have written, I'm trying to say, I wrote this on the 15th of September when energy stocks were starting to rally. And I think one of the things that caught my attention to make me write this article, which has proven pretty accurate, was this cross, the 10 going above the 50. So a lot of these are techniques that in various ways I use to help kind of create content for the blog to spot where the strength is in the market. So that's just what I wanted to kind of show you guys today, because a lot of these tools are not that hard to use. It's just a question of knowing how to use Radar Screen to do it. So here we see, again, I'm sorting here, and it's going to tell me, if I look at the whole list here, it's going to basically tell me, for example, that a lot of these, you'll notice that the technology stocks like XLK, that cross down occurred 8 days ago. That's kind of the period now when it says that we're probably, that could be a time when this was 8 candles back. That's pretty recent. It's less than 2 weeks ago, and it could be a kind of time to take a pause. So I just want to mention that it's been above for a long time, and then it crosses down. Now you will notice back here that it crosses down as well. The issue though is that in many ways this one had been, it had just started rallying. It kind of pulled back, and the thing is that it gave a bad signal here, but then when it comes back up, it still gives you that kind of signal. So this is not like you want to just unthinkingly just jump on whatever this cross tells you to do, but it's generally an indication of which way the wind is blowing. All right, so the thing I like about this is that this is a uniform method for assessing sectors, geography, market cap type, and macro theme. We can be in a great market of, everyone's buying tech stocks. This method I'm showing you with the ETFs will spot that. If we're in a fear market, it will spot that. It will always show you. This method will allow us to diagnose those different market moods simply by looking at where the strength is, if it's cyclical, if it's growth, or whatever. Okay, now I'm going to go back over here and go back to this chart. And this is another chart that I really like. What this does is, now this is a weekly chart. And what this does is this will compare a key ETF to the S&P 500. So this is showing XLK. Now remember, this is weekly. So let's go back to 2012. And you can notice, for example, between 2014 and 2021, technology dramatically increased its share of the overall stock market. If we go to XLE, for example, energy, you can see just the opposite. Energy lost share in the overall market. Now, this is not going to be an exact percentage of what percent the index, the sector is, but it allows us to see the trend, and it allows us to see over the longer term which way strength is shifting. And this is just a useful thing to realize. are we in a sector that is doing well over the long term or not? The thing I would just mention now that is potential is that it's entirely possible, in my view, that this run in technology, which has been the case for pretty much the last, I said it started in 2017. This is when it really became an evident kind of breakout. And this was the period of FANG stocks, like all the FANG stocks. And then this was a period of all the, the Amazon and growth stocks during the pandemic. But I would not be surprised, and there's reasons to think that we're actually at a period where this is now over. And the reason is because interest rates have mostly moved lower throughout this period. And there's a lot of evidence now that the opposite is going to happen. So this can be good to either, it can be useful for trends if you have reason to think you're in the middle of a trend. But it also can tell you, wow, that trend has reached a certain level. It might be reversing now. But this allows you to basically see which sectors are really doing well over a longer period of time. All right. Let me just. The thing I like about all this is objective. It's not based on some analyst saying we think this is great. Our valuation model says something should be happening. All this is telling you what actually is happening. And it allows you to see, for example, the growing or shrinking relevance of a sector within the S&P 500. Okay, the next thing we want to look at are these pre-calculated indexes. This is a different workspace that I also shared. So let's just look at this because there's times when it can be, very kind of useful. Back over on my TradeStation. Here we go. This was the other workspace I shared with you guys, and this is what it looks like. Okay. This has three special custom indexes that TradeStation calculates. Now, TradeStation has a bunch of built-in indicators, or they're really like tickers, like their own symbols that our data farm calculates continuously throughout the day and makes available to us. And if we actually look, the way to see this, if you go to data and you go to edit symbol, you'll notice it has three symbols. And then you have this long thing like $, 20 MASSP and whatever. So I have a nice simple color-coded legend here to explain it. But the nice thing about this, what this allows us to do is this tells us in the three indexes how many companies are above or below their 20-day moving averages, but it's the percentage of the index it is. So what's very interesting about this is, if you look back at April through May of 2020, this is when the pandemic crashed, and then we came back. So the NASDAQ is in yellow. Notice that it very much dominated. It went all the way up to 80% of the NASDAQ was above its 200-day moving average by the beginning of June. So this basically of last year. So this is when the market was still well off its highs. A lot of stocks were still trading like 70, 80% down. But the NASDAQ was already, now this basically told you that NASDAQ stocks and growth stocks are going to outperform. And that's the thing about this. It's very simple. But when you see a move like this, so many companies cross above their 200-day or under, that will then last for months into the future. This doesn't give a lot of signals, but when it does, they can be pretty reliable. And I would say right here, in many cases, this is something that is consistent with the opposite happening. You'll notice how quickly it's fallen. And then it's interesting to look at the Russell here. And this is what I'm saying now about this change in sentiment. Now, you'll notice that the Russell has stabilized and the NASDAQ has come down a lot. It's not as strong of a signal now, but it matches with other things that are happening. And the other thing is you're not going to necessarily see like 80% of the NASDAQ members go under their 200-day moving average, because the S&P is not necessarily going to go under its 200-day moving average. But it is telling you that this is not where the strength is, and it's starting to send some signals here for the Russell. Okay, so what's interesting is if you look at the NASDAQ over the Russell last year, look at, like I said, by June of last year, this gave a very clear signal to stick with tech stocks. And you'll notice how long, how much of a lag it was for other parts of the market that were really lagging. But then when you get the late 2020, you'll notice that the NASDAQ just hangs out here. And then suddenly you get your vaccine news. And look at how quickly the Russell moves ahead. This also anticipated the weakness that we were going to see in, basically between November and June when the NASDAQ lagged. This was our signal to stick with the Russell during that time. So that's just a useful sort of thing. And in many ways, a way to think about the market is, should I be trading Qs? Should I be long Qs? Or should I be long IWM? Should I be in one of those indexes or the other? Because very often the market investors will simply allocate essentially according to those buckets. And then a lot of ways to look at it, but you have the smaller risk on, or you have the large growth stocks. Those are essentially, it's kind of like A or B. And very often it will only be one will outperform and the other clearly doesn't. And, we had a period where the Qs clearly outperformed, then IWM clearly outperformed, and it's not confirmed yet, but there's starting to be evidence that we're going to go into another period of IWM outperforming. And when that happens, or if that happens, we go back over to our other workspace. We look at IWM, for example, which is the Russell small cap. You can see also that this one right now has not gone down. Look, this one made a higher low in September. Look at the Qs, the NASDAQ. The NASDAQ has made lower lows. IWM, even when the market's crashing, IWM is making higher highs. Pretty interesting. This is what I'm talking about, where now we're starting to see the chart shows the same thing that you see over here. And this kind of tells us that potential change in sentiment. Okay, let's go back over. I'm moving on now to slide 14, I think. Good. All right. So now we're going to stop looking at the big ETFs. I'm going to start looking at individual stocks. And there's a few ways here to find different opportunities using this. So let's go back to our workspace. We can find stocks that are testing moving averages. And we can also find some other interesting moving average crosses that you can adjust. And this is, again, we're going back to our radar screen here, but now you'll notice radar screen has two tabs. The first one was your macro top down, what's happening in the world. Your second one is micro level of individual stocks. And this is set to the S&P 500. I'm going to inflate it out and I'm going to show you some of these different things. Hopefully you can see this. I don't want to make the font bigger because it doesn't work as well when I shrink it down. But there's a few things here that we're going to go through and quickly look at. Wait a second. Sorry. So these are some more custom indicators that I shared in that zip file. And this will tell us when stocks are touching an exponential moving average, and this will tell us when it's testing a simple moving average. So very often people want to look for stocks that have pulled back to moving averages. So for example, here's an example of Costco sitting at the 50-day simple moving average. Some people like a moving average like that. There's different, times. There's problems sometimes when something has been rallying for a long time and it pulls back and it just keeps pulling back. And just because it hits the 50-day isn't necessarily a sign. But finding stocks that have pulled back to the 50-day moving average is kind of one of the most universal techniques. And the thing is, this is a guide. If you want to change it, the great thing about these indicators is you can change them. This one will work with exponential. This one works with simple. You can just go in there, go to studies, edit study, and then change the inputted value. The other nice thing about this indicator is what it will do is it will highlight to tell you if the moving average is rising, it will show it as being green. And if it's falling, it'll show it as being red. So that tells you right off the bat, is the direction, what is your overall direction? So I look at something like this and I look at a stock like, it's interesting to look at a stock like Activision. I don't know exactly what's happening with this stock, but this doesn't look like a long to me. This looks like a potential thing you might want to be thinking about as a short. So just notice off the bat that the exponential moving average is, in this case, it's neither rising nor falling. It's a gold line here, but it will just kind of show you these can be opportunities either to the upside or to the downside. And then look, for example, the reopening stocks have been in play. Here we have Alaska Airlines. Here we have Discover Financial. So like I said, financials have been working. It's just interesting to see. You can see it sitting right at that the exponential moving average. So these are just a way to be looking for opportunities. You start on your other tab and you say, wow, I'm I know that financials are strong. You jump over here and then immediately we start finding potential opportunities in the financial space. SYF is another Synchrony Financial, which might not be well known, but they kind of do like consumer finance stuff. So anyway, this is a way you can start finding opportunities based on things that are touching moving averages. Now, the other thing is that this is the same indicator I showed you before with the 10-day simple and the 50-day simple. But now I have it set instead to the 8-day exponential and the 21-day exponential. And the reason why is because a lot of people trade this crossover. They look for the 8-day to rise above the 21-day to go long. And so I have it set in this case. I just change. You'll notice if I go to this one, it's set to exponential and it's set to 8 and 21. So it works the same way with different moving averages. And you can make this if you want. You can say, I want to find stocks that had a golden cross in the last week. You change it to 50-day and 20-day simple. And then you look for stocks where the value is going to be like under 5. Because, between 0 and 5. Because that essentially, wait a second. All right. This tells us that the moving average cross happened. Sorry, my little clickers. If I go here if I drag this down and look for stocks like a value of 4 or 5, BK is the bank. The blue line crossed above the gold line right here. So this is now going to start to tell you stocks where the moving average cross happened recently. There's people who look for this sort of signal and it can be useful. Here's another thing you can do. You can say, I want to find those stocks that had the moving average cross in the last 2 weeks. So you look for everything here where it's greater than 10 or less than 10. I'm going to hold down shift, hit page up and erase everything. And then I'm going to go down to everything where it's 0 and below and erase all of that. Okay. I'm going to just go down, select that, hold down shift, hold page down. Now, everything left had the moving average cross in the last 2 weeks. Now what I can do is I want to say, show me the ones that pulled back in the last week. I hit the 5D. And now suddenly I'm finding stocks that had the moving average cross that have now pulled back. It'll show me in the last week, the ones that are down the most in the last week. I can also look quickly for the ones that maybe are testing their moving average here. And then you see again, Discover Financial. This is a signal that's popping up now, which is kind of interesting. So anyway, this is a way to be drilling down at the actual company level. Now, I just showed you how to use the 5D with this. Now that I erase the S&P 500, I'm going to do select all, or I'm going to do Control A, select all. I'm going to delete, just so you know how to do this. Go to Data, Add Symbol List, S&P 500. That's always included in TradeStation. And by the way, I would recommend, here's just an idea or two for someone who's been using TradeStation a lot. The S&P changes all the time. Companies go away, they merge, their tickers change. It's a good idea once a week to erase your S&P and reload it. Another thing is it's not a good idea to set your price alerts on that list because you're going to want to erase it. So I always keep like a tab for my personal stuff. Like I want to see a stock when it pulls back to a certain level or something. I keep my own separate personal tabs for that. And then when I want to assess the market, because sometimes those things change. So I wanted to share that as a little like hack just to be aware of. All right. So now what we're looking for is the idea of looking for flag patterns. A bullish flag is when a stock is trending higher, pulls back a little, and you want to try and look to buy the pullback. So you can do that now by basically looking for stocks that are going up over the longer term and are down in the shorter term. So the way we would do that is simply looking on the 63D and clicking on the ones that are up the most. And I'm going to go back up to the top of my list. If I just click, it'll toggle. And it'll show me in the last 63 days or the last 3 months, because these are trading sessions. So there's about 21 trading sessions in a calendar month. So this is roughly the last 3 months. The top performer in the S&P 500 is an oil and gas stock, Devon Energy. Okay, great. So now I can kind of look down my list, and what I'm looking for now is I'm looking for companies that are up a lot, but are maybe over here on the 5D column have a negative reading. And here's, Moderna is an extreme case. This is, the vaccine company had this massive rally, and you can see now this is, interesting. I don't know how interesting it is when you think of interest rates spiking and everything else. Bounces like this or pullbacks like this are not often followed by big bounces. But the ones I'm looking for are things that are down maybe 4 to 6% in the last week. And if I look down my list, it's going to just start to potentially find bullish flags. And I'm not sure, like these are ones I don't even know what are or are not the opportunities here now. But you can just look down, you're going to start to see stocks that have maybe pulled back. Now, if you had looked at this a few days ago, some of these energy stocks were in that place. I know this identified Chesapeake, which is a natural gas company. It was like this, it came up on this. I had talked about this in our masterclass, this pullback. It was detected using this technique as a long entry. So I want to just say you would have seen here that you had something that was doing well in the 3-month period, pulled back. In this case, it was also holding the 21-day exponential. So this is just an example of signals that come up from this. And it's not always going to find stuff, but sometimes it will. Okay. So the great thing is just by sorting on time frames, long-term good, short-term bad, you're going to find from time to time bullish flags. The next thing we want to look at is this indicator called distance from 52-week high. So when stocks are hitting new highs, it's just a classic bullish sign. And for people looking to do basic trend following, very often just when stocks have broken out, they pull back a little and they keep running. And so this will highlight when the stock is above its 52-week high, which the way TradeStation works, it calculates a 52-week high overnight. And then if you're hitting a new 52-week high, it doesn't update that until the next night, which is good, because what it means is that if a company's high price of the day is above its 52-week high, it means it hit a new 52-week high today. So this allows us to kind of sort things in terms of how close they are to the 52-week high. And then what I like to do is I like to look for the stocks that are within 3 to 4%, 2 to 3 to 4% of the 52-week highs. And these will be those companies that are pushing the highs and running and just pushing their way higher. This is what it's going to look like when a stock is kind of in a breakout mode and it's advancing. Now, a lot of these, because they're energy stocks, they have this big pullback, but like this method would have found a stock like Hess or something. It would have found it right here. Now, again, this is the same thing would apply to technology stocks when they're running, which they're not now. So another very simple kind of data-based approach to finding your opportunities and your relative strength. Now, another thing is, what did I say? I said energy is doing well. Well, the other column we have here is sector. So, I know a lot of people don't like energy stocks. They've been very weak for a long time. So, whether you don't like them for one reason or another, you probably don't know a lot of them. A lot of people might not know, your general energy stocks or your material stocks or your financial stocks because they haven't been popular for a while. Well, the great thing about this is you can go here and you can just click on sector, and now suddenly it's going to clump them all into groups. So I can now see right off the bat all the energy stocks right here in one set. And I can just look down the list and maybe one of these are going to have some weakness. So the thing about this is right now, energy stocks all rallied into the close. And you can tell I'm kind of focused on them, but it is something that is the relative strength right now. It's so obvious in energy that, say in 1 to 2 weeks or 3 weeks, we get some pullbacks. Maybe they break out and they pull back. What you're going to see is you're going to see the 5D is going to be red. And that's going to start to be the opportunities you want to look for if you're interested in following this sort of trend following. So like I said, if you look over here, you want to find opportunities by sector after finding the strong sectors using the ETFs that we showed before. All right. The next thing are finding active underliers. Now, this is a different kind of approach, but it's something that I think is can be kind of useful because everyone knows the S&P, but the fact is there's a lot of stocks that pop up that are interesting, but people don't always know about them. So, we all know about AMC and GameStop or something, but there's ways to find those names in a systematic way. You don't have to just read the news or like spend all your time trying to find stuff on Reddit or something. There's ways to actually find the stocks that are actively traded. And what you can do is you can use Scanner, and you can find those stocks that trade a lot of options, which is often going to be a sign of heavy liquidity and heavy trading. So how do we do that? All right, let's go over here. I'm going to just open a new tab. Unfortunately, I cannot share Scanner with you. So I'm going to show you very quickly how to do this. I'm going to go to apps. I'm going to go to Scanner, which is a little flashlight, and I'm going to just go and I'm going to create a scan. Let's just call it like, big options or something. All right. My scanner, I'm going to go to all stocks, and then I'm going to next. My scan will automatically include a lot of these criteria because I keep them as default. If you set this, if you select these and you select set as default, it will save them for you. Excuse me. Very quickly, I'm going to just erase these and then rebuild it to show you how to do this. First thing, I'm going to go to criteria. I'm going to go to volume, volume average 10-day. I'm going to go to volume. Actually, I'm going to go to indicator. Now, an indicator is going to run more slowly. This is going to find stocks. Wait, first, let me actually set my criteria. I'm going to say greater than. Actually, you know what? If I look at my list, I set it greater than 50,000. It should be higher than that. I'm going to set it greater than 1 million. So 1, 2, 3, 1, 2, 3. I'm missing a 0 if you actually go to your PowerPoint. Now, this is going to immediately, any stock that doesn't trade 1 million shares a day is gone, is going to make the scan run faster. I'm going to go down here next. There's an indicator, all right? The indicators run more slowly. So we want to use this one up here to reduce the number going in, which will then make the whole thing a lot faster. I'm going to go to, let's go to indicator, volume, all options. And then I'm going to set this. You'll notice it has a separate criteria. I want to set this to volume, all average. And then I'm going to say greater than 100,000 or 10,000 even. I set it to 10,000 in the PowerPoint. So I'm going to run it. So take a couple of minutes. Now I'm almost out of time. So while this is running, I wanted to just quickly just bounce back over to market insights. And I wanted to mention that there's a few interesting things that I look right now that about that jobs report. I'm going to say the economy right now, we've seen our COVID cases coming down quickly. A lot of the economic reports lately were very strong. That jobs report we saw on Friday had all the cyclical areas, construction, professional services, manufacturing were all very strong. The weakness was in things like healthcare and government, which are not driven by the economy, they're driven by other considerations. So it's just kind of interesting when you drill down, you basically see a lot of the industrial reports last month were above estimates. The ADP private sector payroll report was above estimates. So things right now continue to look for that sort of cyclical environment of higher interest rates, strength in financials, energy, and at a certain point, you could start to see some of the industrials doing well as also. So that's kind of the framework that I've been kind of working with now. Another thing that was very interesting last week, and I've written about this. I want to share one other thing. This article I wrote back on April 8th is Tesla overvalued. GM and Ford have both had some interesting electric car news in the last few days or the last few weeks. And it's interesting to look at those in terms of starting to outperform. And those would be value stocks when you compare how they trade multiple wise against GM and Ford. And the last one I want to mention is if you go to markets, cryptocurrency, I have an article here that identifies a series of stocks like Marathon and other companies, Coinbase, that follow the crypto market that have been really starting to outperform as crypto moves higher. So it's great to be with everyone. Thank you very much. Hope you enjoy the rest of the presentations. Thank you, Haley.
Thank you so much, David. As always, that was a great presentation. We really appreciate your time and you being here with us.